There's a global economic story unfolding right now that most people don't see. Not because it's small, but because it's slow. A story involving trillions of dollars in assets, the world's major banks, and the future of our biggest cities. Commercial real estate, the office towers, shopping centers, and warehouses that make up the backbone of the modern economy, has quietly entered one of the most severe corrections in its history. According to the Swiss Finance Institute, the global commercial real estate investment market reached 12.4 trillion US dollars in 2024, nearly triple its size in 2001. But behind that massive number are some troubling signs: rising vacancies, falling values, collapsing deal volumes, and a historic wall of debt coming due, all at a moment when the global economy can least afford more instability. Today, we're breaking down what's really happening inside commercial real estate, why it matters, and what it means for cities, banks, businesses, and all of us. Before we talk about the crisis, we need to understand the sheer scale of commercial real estate. This is not a niche market. It's a massive and deeply interconnected part of global finance. MSCI's Real Estate Market Size Report estimates the professionally managed real estate universe at 13.3 trillion US dollars in 2022, representing 7% of the entire global investable portfolio. The US alone accounts for 5.4 trillion US dollars, or 40% of the global total. For nearly 2 decades, from 2006 to 2022, offices were the single biggest commercial real estate sector. But by 2022, offices saw their market size drop nearly 9% in a single year, more than double the decline of the overall property universe. And this was after years of enormous investment. Between 2007 and 2021, investors poured more than 4.5 trillion US dollars into office assets, more capital than industrial and apartments combined. In other words, the world bet heavily on offices just before the bottom fell out. The Financial Stability Board now warns commercial real estate is a potential source of vulnerability in global finance, with prices already falling and valuations under pressure from thin transaction volumes. Commercial real estate doesn't fall like the stock market, instantly and dramatically. Instead, it declines slowly, like tectonic plates shifting under a city. But the warning signs are already clear. The Bank for International Settlements, or the BIS, for short, reports that office vacancy rates are at all-time highs in many major markets, especially in the United States and China. Even more concerning, the decline in commercial property returns has already exceeded what we saw in the early 1990s. Commercial real estate bust, a period often considered one of the worst in modern history. And historically, BIS notes that commercial property downturns have caused more banking stress than housing crashes. The 2008 housing crisis was the exception, not the rule. In Europe, the pain is already visible. The European Central Bank reports Euro area commercial real estate prices fell 8.7% in 2023, with larger declines expected in office-heavy cities. Global returns have turned sharply negative. In the MSCI Global Quarterly Property Index, returns hit minus 3.8% in late 2022, then bottomed out at minus 6.5% in 2023. And deal-making? It's evaporated. Deloitte reports a 59% collapse in global CRE transactions in 2023. 63% in the US, 62% in Europe, and 50% in Asia Pacific. Even in 2024, despite some stabilization, Q1 deal volume remained 17% below the year before. The office market is where these cracks are widest. MSCI notes that office deal volumes in many major global cities are at record lows. The Wall Street Journal says U.S. office vacancy hit an all-time high at the start of 2024. Australia hit a 30-year high of 15.2% in 2025. And this isn't just a U.S. story. It's everywhere. If rising vacancies are the spark, the debt market is the gasoline. The commercial real estate sector is facing a historic wall of loan maturities, and these loans were originally issued during the era of near-zero interest rates. Now, they have to be refinanced at far higher levels. S&P Global Market Intelligence says $950 billion in US CRE mortgages matured in 2024, and maturities peak at $1.26 trillion in 2027. The IMF warns that around $1 trillion of US CRE debt comes due this year, with a $300 billion refinancing cost gap created by higher rates. Globally, JLL estimates more than $3 trillion in real estate assets will hit maturity by 2025, including $2.1 trillion in commercial property loans, with 75% in the US, and offices represent roughly 1/4 of all upcoming CRE loan maturities. The exact part of the market experiencing the greatest weakness. Loan performance is deteriorating quickly. TREP reports that CMBS office delinquencies nearly doubled in 2024, rising to $17.7 billion or 11% of all outstanding office CMBS loans. The overall CMBS delinquency rate hit 6.57% by end 2024 and 7.23% in 2025. Small banks are deeply exposed. The U.S. Financial Stability Oversight Council notes that community banks hold disproportionately large concentrations of commercial real estate loans, especially office loans. Europe faces similar pressures. The ECB warns that nearly half of Europe's major real estate companies are loss-making, and valuation write-downs have already begun. This isn't just a banking issue. The FSB cautions that real estate investment funds and REITs face liquidity, mismatches, and valuation opacity, meaning stress can cascade across the financial system. So what's actually driving this crisis? 3 long-term structural changes are transforming commercial real estate: remote work, higher interest rates, fundamental shifts in space demand. Remote work isn't a temporary glitch, it's a structural recalibration. The U.S. Bureau of Labor Statistics reports that 35% of workers worked from home part of the time in 2023, up from 24% in 2019. Stanford research finds 20% of all paid U.S. workdays are now remote, a level that has been steady since early 2023. WFH research says remote work adoption condensed 40 years of pre-pandemic growth into one sudden transformation. This has reshaped office demand forever. Deloitte estimates that nearly $900 billion in U.S. CRE loans were scheduled to mature across 2023 to 2024. Many financed at ultra-low rates that are now gone. Higher refinancing rates erode cash flow, push properties underwater, and force owners to walk away, which several major landlords have already begun doing. Retail has been shrinking for years. UNCTAD reports global e-commerce rising from 15% in 2015 to over 22% by early 2020s. Europe faces even more strain. The European Banking Authority notes that fewer commuters and more online shopping have pushed up office and retail vacancy, while regulators require costly energy efficiency upgrades. And across multiple financial stability reports, central banks highlight CRE as a key vulnerability. So what happens next? Most global institutions agree. The correction isn't over. The IMF says CRE stress has become more acute and warns that more distress is likely as refinancing challenges collide with weakening fundamentals. The FSB warns that office valuations in major cities face a structural decline in demand and thin price discovery. The ECB suggests euro area prices may not have bottomed yet, and further declines could trigger redemptions and spillover risks. Capital Economics projects a 20% peak-to-trough decline in U.S. CRE values, and warns office properties may take decades to recover their 2020 prices. Moody's calls the outlook muted across all sectors, a multi-year recalibration, not a rapid rebound. MSCI notes the market may have seen initial stabilization in 2024, but the recovery is a long tunnel, with refinancing risk still unresolved. And JLL anticipates a deep split between future-fit assets, like logistics, data centers, and green premium offices, and obsolete properties that may never recover. Commercial real estate is entering a once-in-a-generation reset. This isn't a sudden crash like 2008. It's a long, grinding transformation, driven by new ways of working, higher financing costs, and shifting economic patterns. The office towers built for the 20th century are colliding with the realities of the 21st. And as trillions of dollars in debt come due over the next few years, what happens next will shape cities, banks, and economies around the world. But one thing is already clear. The commercial real estate market of the future will not look like the past, and the adjustment is only beginning. Thank you for watching my first video. If you got to this point and enjoyed it, please leave a like and subscribe.